What's up everyone, my name is Ale. Welcome back to my world of stocks and welcome back to my 3 stocks on sale series for the month of February 2023, which by the way happens to be the month of my birthday. So thank you in advance for any birthday wishes. But with that said, in this series, I use all of the current market volatility to find you guys 3 new stocks that I think are on sale at today's prices for the long term. And to make things a little more fun and interesting, I specifically look for 1 low risk, 1 medium risk, and 1 high risk option to give you a little more variety as well. Now, with that said, for this month, starting first here with our low risk option, when looking at the giant behemoths that are super low risk, there's really 2 stocks that stand out the most at today's current prices, and those would be Google and Amazon, which I think are absolute screaming buys at the moment as long-term investments. However, I've been talking a lot about Google recently, so this month we'll be looking at Amazon. I personally think Google is the most attractive stock just in the entire market in general, but Amazon is also an extremely solid choice, and I've been buying both stocks super heavy either way. But taking a closer look here at Amazon stock, I would say that right here at around $100 and below is an absolute steal. So I'll be unloading the truck on this one all year long. And I can give you 3 quick reasons why I feel this way. First of all, from the top, Amazon stock is now down a mind-blowing nearly half of its entire value. To give you some perspective, this is about the same price range as their pre-pandemic levels, which is leaving their price to sales ratio about 40% lower than their 5-year average, since they're still growing larger even as the price falls. The market cap has also fallen now from close to $2 trillion down to just about $1 trillion today, making it the only company in the world to lose $1 trillion worth of value. But mark my words, guys, Amazon will eventually be a $2 trillion company. In fact, I even think it'll be a $3 trillion company over the long term. But in the meantime, the reason why this crash matters so much does bring me to reason number 2, which is that the stock price is trading now as if all of the gigantic growth from the pandemic never even happened. Yet we know that during that time, Amazon's revenue skyrocketed from around 280 million all the way up to over $500 billion, and they're still expected to grow this year by a double-digit percentage at a time when everyone is predicting an economic recession. That's wild. This is a much larger company now, yet they're trading way lower. And that brings me to reason number 3. They're going to only become even larger in the future. If you look at capital expenditures, you can see that Amazon is reinvesting most of that money back into the business to ensure they dominate the future of several different markets. In fact, CapEx went from 17 billion in 2019 all the way up to over 65 billion this past year. I mean, how many companies can you guys think of that spend that much money on capital expenditures and growing out their business every year? It's unheard of. Whenever Amazon decides that growth is no longer the priority, but rather to focus on profits, all they have to do is flip a switch, guys, and they'll go from being one of the least profitable companies to one of the absolute largest, most profitable companies in the entire world. And that's the future that I'm investing in, because as it stands, Amazon already dominates some of the biggest markets in the world, including online shopping and cloud computing, and they're quickly becoming much bigger threats in other areas too, like digital advertising and video streaming, and they might even become huge players in other large and growing markets too, like EVs with Rivian, or pharmaceuticals, or artificial intelligence, or gaming. There's really no limit to what Amazon can do or what they're even willing to do. I mean, remember when they actually launched a smartphone back in the day? Now, it wasn't successful, but they were willing to do it. And honestly, I wouldn't be surprised if Amazon tried to launch a smartphone once again, because they already have the whole Alexa ecosystem that they continuously release hardware and products for. So why not build on top of that with a smartphone as well? And you even already have the Fire OS, which you can build on top of, or just kind of merge with Android and have that have the phone be running on that too. But either way, the great thing about Amazon is that they're willing to take any risk, and they really don't care if it loses them money in the short term. And that's really what investors are always worried about when it comes to Amazon, is the profitability. But what they don't realize is that Amazon is this giant dominant company that is still taking risks and still investing in growth as if they were a young startup. And that's why they continue to become larger and larger over time. And when it comes to profitability, they can flip a switch at any moment and they can quickly become one of the most profitable companies in the world. But I love what Amazon is doing, and I love seeing them just continuously adding to their business and taking more risks. And we continue to see that. I mean, we just recently saw them acquire MGM just to add more content to their video streaming service, which they're practically giving away for free. I mean, you have to have a Prime subscription, but that's all they care about. They care about just users getting onto a Prime account, not necessarily monetizing the video streaming part of their business. They just want to get more and more users. In other words, they just want to become larger and more dominant. And when you have a company like that, that's a dangerous company. I mean, in terms of it just becoming larger and larger, but I'm willing to invest in that company, and that's why I own Amazon stock myself. Okay, moving on to stock number 2 though. I'm gonna go with a really controversial company right now for our medium risk option, and that's where all the risk is going to come from. But I also think that it gets balanced out from the fact that if you ignore some of those controversies, you're actually left with a stock here that I believe has a lot of value, market dominance, and a strong dividend as well. And that is going to be the pharmaceutical biotech giant Pfizer, ticker symbol PFE, which is obviously not an easy company to talk about these days because of all the controversy surrounding it. But please don't get too upset with me. I'm not here to give any kind of biased opinions on the V-shot or the pandemic. I'm just looking at this from a purely investment viewpoint. I'm just talking about the stock here. You guys can do your own research, form your own opinions on everything else. I'm just here to talk about the stock. But having said that, some of the controversies around it obviously does add a little risk to the stock. But on top of that, as we slowly move past the pandemic, the V-shot for it may not be needed as much, and investors are worried that that will negatively impact Pfizer's business, which of course is true. And because of that, the stock has already fallen by over 30% from the top and is even down about 15% year to date, while most other biotechs have performed much better. And even though this chart makes it look like the stock has still climbed a lot over the past decade, it really hasn't. In fact, it's still trading today at about the same price it did more than 4 years ago. And even all the way back to the start of the decade, it was still in that $30 range, whereas now it's just in the 40s, which is not a very big climb at all for that long of a time span. And yet despite that, we know that Pfizer is actually an unbelievably way bigger and much more profitable company today than it was back then. In fact, just the pandemic alone caused Pfizer's revenues to more than double in size, which instantly turned them into the #1 largest pharmaceutical company in the world. Back in 2019, they did around $40 billion in sales, but the V-shot in 2021 alone did almost the same amount, and now in 2022, Pfizer did over $100 billion in total, which is not only more than Johnson & Johnson, who used to be the largest pharmaceutical company in the world, and of course J&J is actually much more diversified than just pharmaceuticals, so a better comparison would actually be pure play pharma giants like AbbVie or Merck, and yet Pfizer is doing almost double the sales of those companies too, which is freaking crazy to think about. And so clearly their stock should be trading at a premium, right? No way that a market leader at double the size of anyone else should be trading anywhere close to them. Well, not only is Pfizer not trading at a much higher valuation, and not only is their price to earnings ratio around 40% cheaper than their own 5-year average, but they're actually trading an unbelievable 60 to 70% cheaper than the actual sector that they compete in. That is so crazy to think about, especially for one of the best dividend payers in the space too, with a tiny payout ratio of less than 25% over a decade of consecutive growth and already yielding close to 4%. And by the way, it wasn't just sales that soared during the pandemic. pandemic, their free cash flow literally tripled too, from around 10 billion up to 30 billion per year. And the reason why that's so important is because even as the V-Shot sales fade away, causing their total revenue to drop by around 25% this upcoming year as a result of it, they're actually using all of these pandemic fueled profits to invest in their future, which is something that no one seems to be noticing. In fact, not only has their pipeline already grown to over 100 different drugs and treatments for the future, but in 2020, they acquired antibiotics maker Arixa. In 2021, they acquired antimicrobial specialist Amplyx and oncology specialist Trillium for over $2 billion. And last year, they acquired Arena Pharmaceuticals for a whopping $6.7 billion, Reviral for over $500 million, Biohaven for almost $12 billion, and most recently, Global Blood Therapeutics for over $5 billion. And as massive as all of that is, it's not just companies that they're buying, but they're even expanding their factories and production capabilities to make sure that they can actually build all of these new drugs in the future. In fact, just a couple weeks ago, they acquired a state-of-the-art biologics production facility that they literally state in the documents that they're going to use to produce their new pipeline of products, with the goal of more than doubling the workforce there by 2025. In other words, Pfizer clearly has no plans of giving up their leadership in the pharmaceuticals market, even if and when the pandemic fades away. If anything, they're doing everything they can to actually become even larger over time. And I really think that they're playing the long game here, but investors seem to be so worried about the short term that they're not really noticing what Pfizer is doing. Now, I get that the company is controversial. I don't blame anyone for their feelings either way. If you like them, you don't like them, whatever your thoughts are, we all have our own feelings on that. But just from a stock perspective alone, from an investment perspective, long term, I do think that Pfizer is going to be a successful company, and that's why I'm investing in the stock myself. All right, guys, that's going to leave us now with the third and final stock of the video, and this one also has to be our high risk option. And for these, I usually like to go with the more speculative stock that is being heavily beaten down under current conditions, but that has a lot of turnaround potential if things start going in their favor, which could lead to some big gains if they actually can turn things around. And one stock that I think really fits this bill pretty well is the little known digital advertising company PubMatic, ticker symbol PUBM, which from the top, PubMatic has now lost over 80% of its entire value, as this is a stock that was once trading for as much as $77 a share near their IPO in 2020 before crumbling all the way down to just about 15 bucks today. That's a gigantic crash. And to be fair, there is good reason for that crash, as the company is heavily dependent on digital advertising, which has seen a dramatic slowdown coming off of the pandemic. See, PubMatic helps connect publishers with advertisers and provides them with a platform that handles all of their digital advertising needs, whether it's on websites, mobile apps, videos, or any digital medium. PubMatic will help you advertise on it. And initially, they saw a ton of success from that, especially during the pandemic where everything digital was on the rise, sending their sales skyrocketing with even their profits soaring right along with it. That's right, PubMatic is actually profitable, which is something that you don't see too often in a speculative high-growth tech company that only recently IPO'd. And when looking at the future, PubMatic still has all the potential in the world to keep that growth alive, as they did just a bit above $200 million for the year. Yet, when looking at the advertising market, just programmatic advertising in the US alone, which is their specialty, it's the direct market that they operate in, well, that's already worth over $140 billion. And globally, that number gets even more astounding at over $500 billion. And because PubMatic is so effective at helping the content hosts gain more advertisers while also helping the advertisers themselves run more effective ads through PubMatic's platform, well, PubMatic is able to attract more customers from both sides of the spectrum and collect fees from both. And as a result, they've already attracted tens of thousands of clients, including even some of the biggest companies out there like ABC, Microsoft, eBay, Forbes, and a lot more, which led them to nearly doubling their profits last year. However, the reason why investors are now selling out of the stock is because the digital advertising market is freezing up this year as record high inflation, rising interest rates, and a horrible macroeconomy are causing companies to tighten their budgets in fear of a looming recession. And during economic downturns, we all know that the first thing companies cut is their advertised spending. In fact, Google, who owns the most digital advertising market share in the world, has not only seen their ad growth slow to a crawl, but even their YouTube ad business has seen an actual decline for the first time ever reported in its history. And if YouTube is slowing down, then you can be sure that everything is slowing down, because that's one of the most attractive platforms for companies to advertise on. And that's exactly what we're seeing with PubMatic's growth too. In 2021, sales climbed by over 50%, but are now falling to just around 10 to 15% during the downturn, which is pretty bad and will definitely hurt their profitability. Valuation wise, the stock is pretty cheap though, at a PE ratio below 20 and a PS ratio of about 3, considering that during an economic expansion, we know PubMatic's business could soar and cut that valuation down even lower, especially with their superior margins, because even if you look at their largest rival in Magnite, who also specializes in programmatic advertising and offers many of the same services as PubMatic, well, not only is Magnite way larger and more than twice the size by revenue, but despite their market lead, Magnite actually loses millions of dollars per year and has an operating margin of negative 13%, while PubMatic is positive at 20%. So in my opinion, they're the superior run company, but the only issue with PubMatic is that I think their business is really built for economic expansion, not a recession. And so I think they will struggle heavily during this economic downturn, and especially if we go into a recession and things get even worse. However, I do think that they will recover by a very large amount during the next economic expansion. And I think if we have a recession, I think it'll be relatively short-lived, or a lot shorter than people might think. And I do think that PubMatic can soar once again coming out of that. So I bought a tiny little amount. It's like 0.1% of my portfolio. It's very insignificant. And I did that because I need to make sure that I can buy a lot more if it falls, because I do actually think that the stock can absolutely go lower from here. So it's a very tiny amount. I need to make sure I can buy a lot more to average down. But I think long term, I think it can soar once again. It just needs to be under the right conditions. But anyway, those are the stocks for this video for this month. What do you guys think? Do you like any of these? Do you dislike any of them? Would you have put any other stocks in there? Let me know, and I will consider talking about any stocks you mentioned in a future video. So thanks again for stopping by. Thank you for all the support, everyone. I hope you're all doing well, and I will catch you in the next video. Take care, my friends. Bye-bye.